What I wish I knew at 20 instead of 30. That my mindset could make or break my investment portfolio. Most people think investing is all about numbers, charts, and strategies. But in reality, it's a mental game. Your emotions can either make you rich or leave you broke. Ever felt the rush of a stock going up? That's dopamine, my friend, and it's addictive. But what goes up must come down. When stocks dip, panic sets in, and fear takes over. You sell low, and boom, money lost. Successful investors, they master their minds. They stay calm during the storm, buying when others panic and selling when others are greedy. So next time you feel the itch to make a hasty trade, take a deep breath. Remember, your mindset could be costing you millions. Invest wisely, keep your cool, and maybe, just maybe, you'll turn those losses into gains. Listen up, because we're diving deep into the trenches of your mind, the real battlefield where fortunes are made and lost. Investing isn't just about numbers, it's a constant battle between logic and emotion. You see, even the smartest investors can make boneheaded decisions when emotions take over. The stock market's a wild ride, unpredictable as a bull in a china shop, and our minds often react in ways that hurt us rather than help us. Let me tell you folks, fear and greed are the two wolves that are constantly battling inside every investor. When the market tanks, fear rears its ugly head. Suddenly, everyone's running for the exits, panic selling their stocks like the world's ending. They're convinced they'll lose everything, so they bail at the worst possible time. But here's the kicker. When the market's on fire, greed takes the wheel. Everyone wants a piece of the action, FOMO sets in, the fear of missing out, and they rush to buy stocks at sky-high prices. They think the music will never stop, but remember, what goes up must come down. Remember the 2008 financial crisis? People were jumping out of windows on Wall Street. Fear gripped the market, and investors were selling everything they had, convinced the entire system was collapsing. Guess what? They sold at the bottom, only to watch the market come roaring back later. Don't let fear and greed turn you into a Wall Street chump. We've all been there, feeling invincible, like we've got the market figured out. But here's the truth, overconfidence can be a killer. Too many investors think they're smarter than everyone else. They take on more risk than they can handle, convinced they can time the market perfectly. They're playing with fire, folks, and they're going to get burned. This overconfidence leads to all sorts of bad behavior, overtrading, lousy diversification, you name it. They're chasing every hot stock tip, every whisper in the wind, and it all ends in tears. Remember, the market doesn't care about your ego. Think about all those amateur traders who thought they could outsmart Wall Street. They were reading a few articles online, maybe watching a couple of YouTube videos, and suddenly they're experts. They're convinced they can time the market perfectly, buying low and selling high. But the market's a slippery beast, and more often than not, these folks end up buying high and selling low. Don't let overconfidence turn you into a Wall Street statistic. Chapter 3. Loss aversion, the pain that keeps on hurting. Let's face it, losing money stinks. It hurts, and our brains are wired to avoid pain at all costs. But here's the thing about loss aversion. It can paralyze you as an investor. People feel the pain of losing money twice as much as the joy of making money. Think about that for a second. That means that a $1,000 loss feels twice as bad as a $1,000 gain feels good. It's crazy. This fear of loss leads to all sorts of irrational behavior. Investors hold on to losing stocks for way too long, praying for a rebound that may never come. They're so afraid to admit defeat that they end up digging themselves a deeper hole. Imagine this, you buy a stock at $100 a share. You're feeling good, you're feeling smart, but then it starts to drop. 90, 80, 70. Now you're sweating. But instead of cutting your losses, you hold on for dear life, hoping against hope that it will bounce back. You're emotionally attached to that stock now, and you can't stomach the thought of selling it at a loss. So you ride it all the way down, sometimes to zero. Don't let loss aversion turn you into a deer in the headlights. Outro, keep your head in the game. Listen, we've all been there. We've all made these mistakes. But the key to winning in this game is to understand the psychological traps that are out there. Recognize the signs of fear, greed, overconfidence, and loss aversion. Don't let your emotions cloud your judgment. Remember, investing is a marathon, not a sprint. It's about making smart, disciplined decisions over the long haul. So do your homework, control your emotions, and get ready to ring the register. You need to hear this if you're an investor. Let's dive into 3 pitfalls that can drain your portfolio. First up, Herd mentality, the everyone is doing it trap. Picture this. Bitcoin hits $60,000 in 2021. Everyone's buying, fearing they'll miss out. And then, crash. Many are left with empty wallets. Lesson? Always do your own research. Just because everyone's investing doesn't mean it's a good idea. Next we have confirmation bias. Seeing only what you want to see. Imagine you believe in a hot new stock. You read only the good news, ignoring the bad. Bad move. This can lead to overconfidence and poor decisions. The takeaway? Challenge your views. Look for opposing opinions before diving in. Finally, recency bias, assuming the future will be like the recent past. Remember the 2008 financial crisis? Many thought the stock market was done for. They stayed out and missed a massive bull run. The lesson here? The market moves in cycles. Don't let short-term trends dictate your long-term strategy. So, there you have it. Herd mentality, confirmation bias, and recency bias. Avoid these traps, do your homework, and make smart investment choices. Like and subscribe for more tips to keep your investments on track. What's up everyone, it's Kunal, and let's talk about the mental game of investing. Because look, mastering the psychology of investing isn't about eliminating emotions, it's about learning to control them. See, in the world of investing, your biggest enemy isn't the market, it's yourself. Your emotions can either make you or break you. Fear can make you sell at the worst possible time, and greed can make you buy into hype without thinking. But here's the good news. You can train your mind to think like a successful investor. In this video, I'm going to break down 4 key strategies to help you master your emotions and make smarter investment decisions. Look, the stock market is like a roller coaster. It's full of twists, turns, and unexpected drops that can make your heart race. But just like a roller coaster, the key to enjoying the ride is to stay calm and keep your eyes on the horizon. It's going to have its ups and downs, especially in the short term. You might see wild swings in prices that can make you feel uneasy. But remember, these fluctuations are a normal part of the market's behavior. You might see a stock you own drop 10% in a day and start freaking out. It's natural to feel anxious when you see your investments losing value. However, it's important to keep things in perspective. But here's the thing. Short-term fluctuations are normal. They're just noise. The daily ups and downs are often driven by news events, market sentiment, and other factors that don't necessarily reflect the underlying value of your investments. What really matters is the long-term trend. Over time, the stock market has a tendency to rise, reflecting the growth of the economy and the companies within it. Over the long run, the stock market has historically trended upwards. This means that despite the short-term volatility, the overall direction has been positive. That's why instead of freaking out over every little dip, you need to develop a long-term mindset. This mindset will help you stay focused on your financial goals and avoid making impulsive decisions based on short-term market movements. Think in terms of years, not weeks or months. Investing is a marathon, not a sprint. By extending your time horizon, you give your investments the opportunity to grow and recover from any short-term setbacks. Let me give you an example. Warren Buffett, one of the greatest investors of all time. He's known for his long-term approach to investing and his ability to stay calm during market turbulence. You know what his secret is? Patience. He understands that building wealth takes time and that the market will reward those who are willing to wait. He doesn't try to time the market or make a quick buck. Instead, he focuses on finding great companies with strong fundamentals and holding on to them for the long haul. He finds great companies and holds on to them for years, sometimes even decades. This strategy allows him to benefit from the compounding growth of these businesses over time. He understands that real wealth is built over time, not overnight. The power of compounding returns is one of the most effective ways to grow your wealth. So the next time you see your portfolio in the red, don't panic. Take a deep breath and remind yourself of your long-term goals. Remember, you're playing the long game. Stay patient, stay focused, and let time work in your favor. By developing a long-term mindset, you'll be better equipped to navigate the ups and downs of the market and achieve your financial goals. One of the worst things you can do as an investor is making impulsive decisions based on emotions. When the market is volatile, it's easy to get caught up in the fear and uncertainty. You might feel the urge to sell off your investments to avoid further losses or to buy into a hot stock because everyone else is doing it. But these knee-jerk reactions can be detrimental to your long-term financial health. That's a recipe for disaster. Emotional decisions often lead to buying high and selling low, which is the exact opposite of what you want to do. Instead of reacting to market fluctuations, you need a solid plan that you can rely on, no matter what the market is doing. That's why it's crucial to have a clear investment strategy and, more importantly, stick to it, no matter what. A well-thought-out strategy acts as your roadmap, guiding you through the ups and downs of the market. It helps you stay focused on your long-term goals and prevents you from making rash decisions based on short-term market movements. This means setting clear financial goals, determining your risk tolerance, and choosing an investment approach that aligns with your goals. Your financial goals could be anything from saving for retirement, buying a house, or funding your child's education. Understanding your risk tolerance is equally important because it dictates how much market volatility you can comfortably withstand. One of the most effective strategies is called dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the market conditions. By doing so, you spread out your investments over time, which can help mitigate the impact of market volatility. This means investing a fixed amount of money at regular intervals, regardless of what the market is doing. Whether the market is up or down, you continue to invest the same amount. This approach takes the guesswork out of investing and ensures that you are consistently putting money into the market. This strategy not only takes the emotion out of investing, but it also helps you buy more shares when prices are low and fewer shares when prices are high. Over time, this can lower your average cost per share and increase your potential for gains. It's a disciplined approach that can help you build wealth steadily. Think about it. Investors who panicked and sold during the COVID-19 market crash locked in their losses. The market was in freefall, and it was a scary time for everyone. But those who stayed the course and continued to invest according to their strategy were able to take advantage of the market recovery. But those who stuck to their plan and continued investing actually came out ahead. They were able to buy stocks at lower prices and benefit from the market's eventual rebound. This is a perfect example of how sticking to a well-defined strategy can pay off in the long run. They were buying stocks at a discount when everyone else was selling. This disciplined approach allowed them to accumulate more shares and position themselves for greater gains when the market recovered. It's a testament to the power of staying committed to your investment strategy. Remember, discipline beats emotion every single time. By having a clear strategy and sticking to it, you can navigate the uncertainties of the market with confidence and work towards achieving your financial goals. So, take the time to develop a solid investment plan and stay the course no matter what. Chapter 3. Avoid emotional investing. Let's be real, we've all been tempted to buy a stock just because it's going to the moon. The excitement of seeing a stock's price skyrocket can be intoxicating. You might feel like you're missing out on a golden opportunity if you don't jump in right away, or because everyone on social media is talking about it. Influencers and so-called experts can make it seem like a no-brainer. They often hype up stocks, creating a buzz that's hard to ignore. But let me tell you, FOMO, the fear of missing out, is a dangerous emotion when it comes to investing. It can cloud your judgment and lead you to make impulsive decisions that you might regret later. Remember, investing based on emotions, whether it's fear, greed, or hype, is a surefire way to lose money. Emotional investing can cause you to buy high and sell low, which is the exact opposite of what you want to do. Instead, base your decisions on solid research, company fundamentals, and historical trends. Take the time to understand what you're investing in. Look at the company's earnings, revenue growth, and profit margins. Look at a company's financials, understand their business model, and how they make money. Are they in a growing industry? Do they have a competitive advantage? Assess their long-term growth potential. Are they innovating? Do they have a strong management team? These are the questions you should be asking. Don't just jump into something because it sounds good or because everyone else is doing it. Peer pressure can be just as dangerous in investing as it is in other areas of life. Think about it. People who panic sold during the COVID-19 market crash, based purely on fear, missed out on one of the fastest recoveries in history. The market rebounded quickly, and those who stayed invested saw significant gains. They let their emotions get the best of them. Instead of sticking to their long-term plan, they reacted to short-term market movements. So before you hit that buy or sell button, take a step back and ask yourself, am I making this decision based on facts or feelings? It's crucial to differentiate between the two. If it's the latter, you might want to reconsider. Take a deep breath, do your research, and make sure you're making a well-informed decision. Investing should be a rational process, not an emotional one. By keeping your emotions in check, you'll be better positioned to make smart, profitable investments. Chapter 4. Understand risk management. Now, I'm not going to sugarcoat it, investing always involves some level of risk. But here's the thing, you can manage that risk effectively. The key is diversification. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, like stocks, bonds, real estate, and even alternative investments. This way, if one investment goes down, the others can help cushion the blow. Think of it like this. If you invest all your money in a single stock and that company goes bankrupt, you lose everything. But if you diversify your portfolio, a loss in one investment can be offset by gains in others. You're essentially protecting your downside while still giving yourself the opportunity for upside potential. Remember, smart investors don't just focus on making money, they focus on preserving their capital, and diversification is one of the most effective ways to do just that. Outro: control your emotions, control your investments. Look, at the end of the day, investing is a marathon, not a sprint. It's about making smart, rational decisions based on logic and discipline, not letting your emotions get in the driver's seat. If you can control your emotions, stick to a disciplined plan, and manage risk effectively, you'll be ahead of 90% of investors. Remember, the best investors aren't necessarily the smartest, they're the most patient and disciplined. They're the ones who can control their emotions and stick to their plan even when things get tough. So, stay focused, stay disciplined, and remember, you got this. If you can control your emotions, stick to a disciplined plan, and manage risk effectively, you'll be ahead of 90% of investors. The best investors aren't the smartest, they're the most patient and disciplined. Why do 80% of investors struggle with emotional control? It's not just you. At the end of the day, investing is a mental game. The biggest difference between successful and unsuccessful investors isn't just knowledge, it's emotional control. Picture this, the market takes a nosedive and your first instinct is to sell. But those who master their emotions, think long-term and stick to a strategy, those are the ones who achieve true financial success. Remember, the stock market is like a roller coaster. There are ups and downs, but if you stay calm, buckle up, and trust the process, you'll come out ahead. Emotional control means not letting fear, greed, or overconfidence dictate your actions. So, take a deep breath, stick to your plan, and watch your investments flourish. You've got this. But now, I want to hear from you. Which psychological bias do you struggle with the most in investing? Is it fear, greed, overconfidence, or something else? Let me know in the comments below. And if you found this video valuable, don't forget to like, share, and subscribe for more content on mastering money and mindset. See you in the next one.